On the Express this week, the cold winds of volatility are blowing through the markets. Could this be a correction, an inflection, or just sector rotation? Bonds are back, and we like them shaken, not stirred. Keith Lerner of Truist Wealth drops in with some truth syrup for us in a few minutes, and all eyes on Nvidia this week. No pressure. And could people's pick of the year for the sexiest man alive be a recession indicator, the Investopedia indicator of the week, and what to watch? Kick, push, and glide. Pure finesse. That's how we ride on the Investopedia Express. Welcome back and welcome aboard. Good to be back in the headquarters of the Investopedia Express. Been all over the place over the past week. Welcome to all of our live viewers and watchers and streamers from all over the world. We know you're out there, the smartest investors on the planet, tuning in to the Investopedia Express. It is good to be back, good to be with you. And volatility is bringing in a little bit of a chill. Market shaky last week, really the last couple of weeks, and starting off today a little bit on shaky ground, but we're seeing some ground recovered after last week's sell-off. Is this normal volatility? Is this what we should expect in November? Is this what we should expect with so many people talking about a potential AI bubble, all these concerns about overvaluation, stocks at record price to sales ratios, price to earnings ratios? Yeah, that's all happening right now. Is this bubble getting a little bit thin, or is just good old-fashioned sector rotation? There's your past 5 days for the S&P 500, the NASDAQ, and the Dow Industrials, all falling a little bit. But if you take it back to October 29th, when this volatility really began, right before Halloween, right before my birthday, the S&P 500 down just 2.3%. Feels like a lot more, and sometimes that's just what it happens. Things get noisy. We get a lot of volatility. We haven't had a lot of day moves of 1% in one direction or the other until the past couple of weeks. But volatility, pretty normal, especially when the bull market is getting a little bit old, like this one is now passing its third birthday, heading into its fourth year. But a little perspective from our good friend Sam Stovall at CFRA on these little hiccups that we see in the market, especially near record highs here. We see since World War II, average declines following post-correction recoveries have been less than 10%, but the drumbeat's getting louder around a 10% reversal or correction, and that would be totally normal. To have another 10% correction would be totally normal. Now, we had one in April. We had a 19% correction. It was almost a bear market, but that was headline induced from tariffs. But to get a 10% correction in the middle of a pretty strong bull market, totally normal. And since the bear market of 2022, we've only had 2 corrections. That's not normal, my friends. Usually you get one a year. Now, we've had one this year, again, headline induced, but we've only had 2 over the past 3 years. That is not normal. It doesn't seem like it, but that's actually not the way things are supposed to go. Let me take you back to 1956, 1980, 2000, and 2020. 3 to 5 corrections during those bull markets. That is normal. And it's also the price we pay for volatility. So you got to have perspective. You got to have perspectives. And investors, seems like they've had perspective. Over the past year, we've been all in terms of investing, especially in the risk-on part of the market. Good chart here from our friends at BofA Global Research here. And record inflows into equity ETFs, record inflows into tech, that's where the gains have been, and record inflows into investment grade bonds. Where's the money flowing out of? Real estate and small caps. That could change as rates go lower, but just take a look at that. We've been pouring money, especially into exchange traded funds on the equity side and leaning heavily into tech. That's why everybody's a little bit nervous about the fact that we might be over concentrated. But don't ignore the rally in bonds. Speaking of bonds, no, not James Bond, although shout out to Daniel Craig, one of my favorite James Bonds out there. And no, not Barry Bonds. Great swing. Will he be in the Hall of Fame? Who knows? But nobody had a better swing than Barry Bonds. We're talking about bonds. We're talking about government and corporate bonds. Those have been in a bear market really for the past 5 years. Not so much in 2025. If you look at the Bloomberg U.S. Aggregate Bond Index, that's what they call the AG out there on Wall Street and over at Bloomberg up on 58th Street and Lexington Avenue. The AG index up 6.7%. And what is the AG, you say? Well, the AG includes a wide range of investment grade, fixed rate, U.S. dollar denominated taxable bonds from 4 main sectors: U.S. government securities like treasuries, government related debt, corporate bonds, and securitized debt like mortgage-backed securities. And why is all this happening? Why are bonds suddenly rallying? Very rare to see bonds rally like this at a time when the stock market has been so strong. Sometimes they pull in opposite directions depending on economic forces. Well, the answer is that the Fed is going to be lowering rates. It was battling inflation for the past few years. Inflation's still around, but inflation was much higher several years ago. We all remember that. Well, the Fed battled inflation with higher interest rates. Higher interest rates pushes up the yield on these bonds and pushes down the prices. They work in opposite directions. So as the Fed lowers rates, inflation seems somewhat under control, somewhere in the 3% range. That's good news for bonds, especially for fixed income investors or those who are trying to have a balanced portfolio and have those bonds be that stabilizer in their portfolio against the riskier part of the assets they own, which could be stocks, could be crypto. So the fact that the aggregate bond index, the AG, is rallying this year, good news for fixed income investors. And also another sign, rates are headed lower and investors are becoming much more comfortable with lower yields on these bonds as long as they're getting higher prices. Well, while volatility is the price that we pay for earning long-term returns, it still gives us the willies, right? The financial media, and you can include me and Investopedia in all of that, we like to over-dramatize things, both on the way up and on the way down. And when things get volatile, we like to turn up the volume a little bit, make things a little bit scary. That's how we get you to pay attention to us. That's what we do to get your attention, guilty as charged. We try to educate as well, but that's the name of the game. But if you want real perspective, you got to go with the pros. The wealth managers who actually allocate our assets for a living. This is their job. And one of the pros I like to turn to is Keith Lerner, the Chief Investment Officer and the Chief Market Strategist for Truist Wealth. He joins us now on the Drop In. Keith, thanks so much for joining the Investopedia Express.
Yeah, great to be here. A lot to talk about with markets.
Yeah, we were together this week at the Yahoo Finance Summit, and we were already seeing a little bit of a pullback and a little bit of a rotation going on. The last few days to end the week have been kind of extreme, but as you write in your note, you still have a bull market bias, and this is kind of normal when you think about seasonality and the way markets kind of trend.
Yeah, it's been an interesting year. I mean, we have to also remember perspective-wise, we are coming off one of the strongest 6-month increases in the history of the stock market. We were up more than 35% off the April lows. And then you think about the technology sector was up 60% and semiconductors up 100%. And while that feels good, we also know historically it's often 2 steps forward, 1 step back. And probably what's more unusual is that we haven't even seen much of a setback since all the way back in April. So I think that's what's happening. I think we're having a little bit of a reset of prices that got stretched a little bit and sentiment that became, a little bit one-sided. And we're just seeing a reset. But the underlying trends, as far as earnings, the underlying price trends in our work, still suggest, as you mentioned, that this kind of bull market deserves the benefit of the doubt.
And what I love about your research is that you do both the fundamental analysis and the technical analysis. You mix the two, which is a great way to look at both price trends and what's actually happening underlying these companies' profits. And company profits have been super strong as usual. So I think that's what investors have been betting on. That said, from a trend perspective and just from a seasonality perspective, pullbacks of 5% or so are not crazy. And we could even see another correction.
Yeah, I always say, the pullbacks are the admission price for investors for the potential of those higher long-term returns of equities, but they always come with something, and that's bad news, right? When you have pullbacks, there's a headline around that pullback that makes people nervous. And to be fair, every bear market starts with a pullback. So there's always a possibility of something more sinister. We follow the weight of the evidence approach. No one has a crystal ball, but as you mentioned, we try to combine, history, the economic cycle, and then fundamentals and technicals to give us a higher probability decision-making process. And then also sometimes the fundamentals will be saying this, and then prices are acting a different way. It may just say, okay, are we missing something? It causes us to dig in deeper in our analysis.
Yeah, well, you've been writing and talking about for months this two-speed market and economy, and there is definitely that going on, pulling in different directions. The economy feels like it's softening a little bit. The stock market was doing very well. They're not the same. In fact, they always usually dance to a different beat. But even in the economy, you're seeing spending at the higher end of the range, especially for higher income people, and you're starting to see a slowdown in the labor market. Describe a little bit more of the manifestation of the two-speed economy.
Sure. Yeah. So we'll focus on that two-speed economy first. As you mentioned, if you think about the high end, I think a lot of us know this. The stock market, even though we're having a little bit of a pullback, is at all-time highs, and we've had consecutive double-digit gains. So people are feeling good. A lot of folks in the who who own homes and seeing those prices move up are also feeling good. So you have this high end that you're seeing stock market wealth, they're seeing housing wealth, they're seeing some stability in their jobs. And then on the other side, the low end is feeling a little bit more squeezed. Early out of the pandemic, wage growth for the low end actually rose more quickly than the high end because there was all this demand for workers, and that's actually slowed down a bit. And then even though we're seeing some moderation in inflation, most people look at inflation that things are a lot higher than they were 2 or 3 years ago, not the way economists look at it, saying, hey, we were rising at inflation at 6, 7, or 8%. Now it's only 3%. Well, it's still much higher before. And those same people, they don't have the same amount of money proportionally in the stock market, and a lot of folks, can't afford a home. So that two-speed economy persists in aggregate. Since that top end is the biggest driver of spending, that we expect this kind of muddle through to continue. But I think that's likely. This kind of muddle through two-speed economy is likely to persist as we move into next year. Maybe with some of the stimulus that we see in the first quarter, maybe people start to feel a little bit better at the lower end, but it's also, we really have to watch this job market as well.
Yeah, that's been slowing too. And we know that prices are going to rise probably around healthcare, health insurance premiums, one way or the other. But as you look at it from a chief market strategist perspective, and I'm getting this question a lot, and I'm not a chief market strategist, but without, that hard government data that you and I and economists and everyone's used to getting, CPI data, jobs data in a timely fashion, how do you make decisions around allocation? How do you make decisions around risk right now?
Yeah, so I would say the one thing on the economy, we don't have the full picture, but there's enough third-party data to have a pretty good sense of where we are. And then when I think about the stock market, we often say the North Star of this bull market has been profits, and we just went through an earnings season. So we also have a good gist on that side. So I'm actually focusing more on the earning trends than, this kind of muddle through economy and not having the data exactly. I still feel like we have a sense that it's muddling along still. And when I think about the overall market, we're not early in this bull market cycle. We just had a 3rd-year anniversary. But we also, going back to our weight of the evidence framework, we start with that historical lens and say, okay, since 1950, we've had 10 bull markets, at least the way we calculate it. 7 of those previously turned 3 years old. And what we saw the following year, all of them were up. Now, that's a small sample. I can't just say, okay, well, they were up and this is going to happen the same way. But at least to us, that's a starting point. And we do expect a modest uptick in the economy, and we expect earnings to continue to move higher. So going to more directly to your question, I would think big picture, we still lean with a modest equity bias overall. We're still, I would say, Team USA as far as equity allocations, even though international has really outperformed this year. To me, a lot of this is mean reversion because international developed markets, as an example, underperformed by the most since the 90s last year. And we came into this year with really low expectations. But with that said, we did increase our international exposure from where we were a year ago. And I think it's important to note that when we look around the globe, more than 90% of countries that we track are in uptrends. And you're seeing things like, even with all the uncertainty in Europe, seeing European banks around 52-week highs. You saw Japan at 52-week highs as well. And you're seeing emerging markets where this kind of strategic battle with the U.S. on AI also doing relatively well. So I think diversification, even though it feels like it hasn't worked over the last couple of years, this year is working. I expect that it will work again next year as well.
Yeah, so I was going to say, what does an actually globally diversified portfolio look like going into 2026, given the outperformance of international markets, looking at places like Korea, places like Japan, even Greece and Poland, where we don't normally allocate on a regular basis. How do you actually diversify in a way that feels safe, but also gives you enough risk potential?
Yeah, well, I think it's also like people say this, like everyone's different, and they are. I mean, the way, even as a strategist, when I talk to even clients, they say, "What do you think about the markets? How should it be invested?" I say, "I don't know anything about you. Like, what is the goal of that money? How long are you going to, have that money in the stock market? And also, what's the goal? I mean, the goal is to make money, right? Everyone wants to make as much money as they can with the least amount of risk, right? But you kind of start off there as your foundation. And I think, we have different, say, kind of benchmark allocations for different categories of investors. And during the cycle, there may be times saying, okay, this is the benchmark that we've come up with. Do we want to be on offense or more on defense or somewhere in the middle? And I would say, relative as an example, like to like a 50-50 portfolio, we would have a slight overweight to equities. We still think diversification as far as high quality fixed income actually has worked this year. I mean, a lot of concerns about deficits and inflation, but plain old vanilla bonds are up 5 or 6%. Not exciting, but they're not supposed to be exciting. We also have been more positive on gold this year. We've been positive all year on gold. I will say on a short-term basis, things got a bit stretched. We're not big gold bugs per se, but we think that there is a diversification benefit, so more modest positions. What's interesting, we did a study that looked at this year when days where stocks and bonds were both down, gold has been up more than 50% of the time. So there is a diversification impact there as well. So, I also say just this last week, since so much focus on AI and tech, and we like that area of the market still, we've been positive all year. But sometimes people say, well, especially when it's just going up, is why don't I own only AI and tech? And I think the last couple of days is a reminder of that. And also, you and I remember the 90s when there was something called the four horsemen of tech, which they did great in the 90s. They didn't do great afterwards for a long time.
Yeah, leadership always changes. There's always sector rotation. There's always a bull market somewhere, and you always get these trends. So for investors, and I've been getting this question a lot, I'm sure you have as well, could this get worse? And what indications would tell you that this is going to get worse, both from a price trend, because I know you watch price. Price is what matters to technical analysts, but also from a fundamental perspective. What do you need to see to tell you that things are going to get worse? Or on the flip side, things actually might turn around from here?
Yeah, and I would say, our big picture, not trying to call the exact low and like the next 3 to 5%. For those folks, if there are still some folks underweight tech and growth, we would actually use this opportunity as a time to lean in. Again, not trying to call the absolute bottom. And what we're looking at right now is a couple of things. I mean, one, even we talked about this yesterday, is a lot of questions are we in a bubble? When we look at and try to quantify it, we don't see a bubble. There's some richness, there's some frothiness, which actually is coming out of the market somewhat. But if we look at over the last year, the technology sector is up, about 30%, probably a little bit less now after this setback. That's strong, but it's not anywhere close to the bubble territory we saw in the late 90s, which was more like 100% year over year. So again, 25, 30% currently up over the last year versus almost 100% or more. Then valuations for the technology sector is around 30 times, again, rich, but not comparable to the 50 times that we saw in the technology bubble. Doesn't mean we have to get to a technology bubble to have a correction, but I will say, you asked, what are we watching? It does come back to profits. One thing with the technology sector that we've seen really, especially over the last 5 years, is when the earnings momentum is stronger for tech relative to the overall market, it tends to outperform. In 2022, the earning trends relative to the market were moving down. They've been moving up since this kind of chat GPT low in October of 2022. So for us to get more negative, it would likely be that we start to see that momentum in earnings come down. And I think the other thing that could happen, which would be a good scenario, I think, is that if this uptick in the economy that we think happens next year, people gain confidence in the economy, you have a little bit less, uncertainty, and investors feel more comfortable to rotate to other areas. We saw that this last week with healthcare, a little bit in some of the big financials. You could see kind of money rotating out of tech, but I do think because of composition, tech needs to participate, if not lead, for this market to actually see gains at a headline level.
We talked about it earlier last week on the Yahoo Finance Summit together. Most individual investors are overweight tech. When you look inside their portfolios, and we ask them this through our sentiment surveys every 2 months at Investopedia, it looks like the NASDAQ 100 plus a couple of other stocks, maybe a JP Morgan Chase, maybe a couple of healthcare stocks, maybe a Berkshire Hathaway. But basically, the biggest, heaviest stocks are the ones that individual investors own the most of. So kind of we're in the in the heavy side of the boat already. Is there a concern that we're so many people, especially on the retail investor side, are loaded up there that big pullbacks like this might do a little bit more damage than might normally happen in a more balanced market portfolio?
Yeah, no, it's a great point. I actually think this is a great, like, as an individual investor, like, you've seen some of these, and especially the headline market is only down 2 or 3%. Technology is down 5%, but we're seeing some names, and the ones that you're talking, these kind of really hot tech names down 20, 30%. So, as an individual investor, I think this is kind of a good gut check. Were you, like, every day, like, really concerned with your portfolio, looking at the market and, like, feeling like that pit in your stomach? If so, even though we still like tech long term, it may say you have too much weight there, and I know it's hard. And another thing I hear about as well, I got so many embedded taxes there. And I often say, like, that's not a great necessary excuse. No one likes to pay taxes, but sometimes the market will take care of that for you because you feel like you're constrained to not doing anything to the taxes. In some ways, you can also celebrate that you've done something right. So, and again, there's not an exact level. I wish I could say this is the level you should be at, but we still, even though we have biases and we overweight and underweight areas, we don't believe in going all in, because the reality is the future is unknowable, right? We can use a way of the evidence, we can get the probabilities on our side, but there could be something that came out, like, remember early this year, it seems like a long time ago, DeepSeek came out and people were really concerned about tech. So I think, having some of those offsets that we talked about earlier, and then really using this most recent pullback as a gauge of your kind of fortitude, because this is in the grand scheme of things, what we've seen recently is really not a really deep correction relative to what we've seen in the past, and that could happen again at some point.
It's all about perspective, right? Let's go out on this. What's the one thing you don't think that's getting enough attention, or that investors or market watchers are focused on, that you think could be important going into the end of the year?
Well, that's a good, make me think a little bit on that one. It's the one thing that we all watch, and I think is the one thing we should be watching, which is really, tech is the leadership. It's the one thing that has brought this market down. And I think for this market to re-engage, it's going to be all about tech. Maybe I'll flip the question a little bit, if that's okay, because I don't know if I have a great answer for your first one. Is that I think there's so much fixation on what the Fed's going to do, whether they're going to cut rates in December or not. And to me, it kind of overstates the importance of the Fed in this overall market. I'm not saying they're not important, and they are important for parts of this market, like small caps, the interest rate sensitive areas of the market. But you got 2022, we had the rates move up a lot. That's why everyone thought we were going to go into recession, and the economy proved somewhat less interest rate sensitive on the way up. I would suggest that the market and the economy may be a little bit less interest rate sensitive on the way down. So I think this obsession with what month the Fed cuts rates is probably a bit overdone. And I would focus a lot more on corporate profits. And we still have next week, this week, we're going to have Nvidia and some of the home builders and retail. I think getting the sense of the economy and the labor market and tech earnings is going to be more important than what the Fed does in December.
Yeah, they pretty much told us what they may or may not do all the way until the end of next year. Great advice, as usual. Keith Lerner, the Chief Investment Officer and the Chief Market Strategist for Truist Wealth. Thanks so much for joining the Express.
Yeah, it was really fun. Thanks so much for having me.
Great stuff there from Keith Lerner. We're going to link to his perspectives and all the insights from the Truist Wealth team in the show notes. But if you want someone who has a pretty steady view of the markets, Keith and his team do a great job over there. Again, we'll link to that research, and let's get to a little money in motion, because it speaks exactly to what Keith and I were just talking about. Not only have we seen record inflows into equity ETFs and tech so far this year, we've seen a lot of retail investors buying a lot of individual stocks outside of their defined contribution plans. I like to look at Banda Research and other sources to see what you, me, the Joes and the Janes of the world have been buying and selling outside of our normal picks, or of our normal allocations in our 401ks and our IRAs. And the top stocks bought by retail investors through the month of October, guess what? Your portfolio, my portfolio. This is what investors have been holding and buying for the last several years, and what a lot of them tell us through our sentiment survey they're going to buy and hold for the next 10 years. Nvidia, Meta, Microsoft, Amazon, and Palantir. And a lot of those stocks had some volatility over the past few weeks, especially as investors have come to expect so much from their earnings results. And we're going to have a lot higher expectations for Nvidia when it reports later this week. We'll get to that in a second. What have we been selling? The Joes and Janes of the world. We've been selling some chip stocks, AMD, right? Intel. We were big sellers of those stocks in the last month. Also Tesla and Lilly on that sell list, though. So sometimes we get it right. Sometimes we get it wrong. Sometimes it's just easier to buy the indexes and the ETFs like we've been doing so far this year. All right, we got a busy week ahead, and it all focuses on Nvidia, plus a lot of other reports coming out. Let's see what's coming on down the tracks at us this week, what to expect in this very important trading week. And guess what? The government shutdown is over. Hallelujah. Hallelujah. That ended last week, and we're finally going to get some government data. I feel like we've been starved for that good government data for, I don't know, 3, 5, 6, 7 weeks right now, and we're finally going to get some of those reports coming back at us, and they're going to be super rear view mirror because those things happened like 4 to 6 to 8 weeks ago. But let's check it out. On Monday, today, we get the Empire State Manufacturing Survey. That's important. What's the state of manufacturing here in the great state of New York? We'll check that out as well. Some earnings today from Aramark and other companies. Tuesday, Home Builder Confidence Index for the month of November. It has not been very strong, as you can imagine. Housing market still stuck in neutral, waiting for a breakout. Hopefully rates coming down will instigate a housing market rebound. We'll also get industrial production and capacity utilization for October. Again, rear view mirror government reports coming our way, but very important earnings this week from retailers in general, but especially Home Depot. We'll get results from Medtronic Tuesday as well, Baidu and Klarna. And then on Wednesday, all eyes on Nvidia, especially CEO Jensen Huang and the comments he will be making about the company's results and the forecast for demand going forward. And if Nvidia and Jensen Huang say there's demand for its chips and it's insatiable, well, that's going to be good news for the markets, because that has been one of the key drivers of this market rally for the past several years right now. So hopefully investors will hear what they want to hear from CEO Jensen Huang of Nvidia on Wednesday. But also on Wednesday, we'll get existing home sales. We'll get the FOMC minutes from the last meeting when they said they may not lower rates again at this meeting. We'll pour through those as well. Also earnings from Lowe's and Target, among those other retailers, reporting this week. And on Thursday, the jobs report for the month of September. Yeah, like 2 months ago, we'll finally get those results. We'll see if the unemployment rate actually rose during that month, as we got a lot of government layoffs and we had the beginning of a lot of corporate layoffs. We'll get to look at that, but it is very old at this point in time, paying a lot more attention to the private payrolls reports because they're actually helping us, and the initial weekly jobless claims. We haven't had one of those in a couple of months. We'll get that on Thursday as well. Earnings from Walmart. That's going to be huge. Walmart CEO announcing he will retire at the end of this year. Always interesting when a CEO announces his retirement the week before earnings. Let's see what's actually in those earnings. We'll also get results from Intuit and Gap, among other companies. And then Friday, consumer sentiment, the final reading for the month of November. We know from the latest consumer confidence survey from the University of Michigan, we're at a 3-year low, almost at an all-time low in terms of our confidence. But with the government shutdown being over, maybe we're feeling a little bit better. And then earnings from BJ wholesalers. But it's all about earnings. You heard Keith Lerner talking about it. We've been talking about it. Earnings have been strong, and that is what investors are paying for. We're paying for you to make profits, because those profits usually translate into higher stock prices, along with dividends in some cases, and earnings have been strong. The latest out from FactSet Insights, 13.5% S&P 500 earnings growth in this last quarter, right? We're seeing all S&P 500 companies at around 13.1%, and then companies with less than 50% of revenue, almost 13%. That is strong profit growth, no matter how you look at it. And that, again, my friends, is what we're paying for. All right, let's get to the indicator of the week, because if things are so strong, if the economy is in such good shape, then why have shipments, and I'm talking about transatlantic cargo shipments, rail shipments, train semi shipments, why have those been fading? I like to look at the Cass Freight Index of shipments, and that is telling us that shipments have been declining pretty substantially over the past couple of months. Now, is that tariff related? Or is that just the fact that orders have not been that strong? Well, the fact that we haven't gotten a producer price index in a while and a lot of government reports, we actually don't know. So the Case Freight Index of shipments, always a good indicator, and it has been trending lower. We'll see if that picks up a little bit as we head into the holidays, because if it looks like that going into the holiday season, I don't think we're going to get such a strong holiday shopping season. All right, one more bonus indicator, and this from our good friends at People Magazine. We love People here at People. People coming out with its pick for the sexiest man alive for 2025, Jonathan Bailey. Yeah, my kids were into this, my two daughters and my wife, which tells you that it is a pretty solid pick when you get your wife agreeing with it and your daughters, and my nieces think it's a great pick, and everybody I know saying, great choice, Jonathan Bailey, Bridgerton, Wicked, that's a good choice. Well, good for us, good choice by all the great editors at People sitting upstairs for me right here at People Inc. But there is a recession indicator that one TikToker pointed out. Erin Baldwin, TikToker, pointing out in her TikTok post that when People editors get it right with the sexiest man alive, we often fall into a recession here in this country. That's not scientific, but she did do the math and she did track it back. And actually, when People gets it right, like they did back in 1991 with Patrick Swayze, when he was the sexiest man alive. I remember that cover. My sister used to get People magazine. We fell into a recession. 2000, Brad Pitt coming right off of Fight Club. We had a recession, right? 2001, Pierce Brosnan, right? One of the other James Bonds. Not one of the best, but still, we love Pierce Brosnan. Recession came right after that. And then, of course, 2009, Hugh Jackman. Those are all recessions below there in the gray. And those were the picks by the editors of People for the sexiest man alive. Again, not scientific, not something I would trade my portfolio on, but very interesting. And it's also a good read. The Sexiest Man Alive issue out now on newsstands. And that is your other indicator of the week. Again, not something to make investment decisions on, just something to talk about at the next cocktail party with your next issue of People magazine. Shout out to the good folks upstairs at People, and shout out to all of you for joining us, and special thanks to Keith Lerner for jumping on the Express this week again. So good to have his perspective. We'll link to his notes in our show notes. And to all of you joining us from around the world, thanks so much for being part of the Investopedia Express. This goes on demand on your favorite podcast networks, wherever you listen to podcasts. And we'll talk again a little further on down the line.